What's going on, everybody? So in today's video, I'm going to be going over how to pay off your mortgage in 5 years or less. And this is actually based on a book I just read. It was an amazing book. I'll put a link to it, and I'll just go over 10 things I learned from this book, as well as how to pay off your mortgage in 5 years or less. So overall, this was a very quick read, a very short read, but tons of value. You know, there's a lot of people that think to write a book, it needs to be like 5 hours long. This book was probably like under 50 pages. Probably took like 30 minutes to read. So definitely recommend checking it out. And the author has actually used this strategy, according to what he says, to pay off like numerous houses. And he's continuing to do this. And it's a really cool, unique strategy that you don't really hear too much. You hear a lot of people saying, oh, if you make one extra mortgage payment every year, you know, you pay it off in 21 years as opposed to 30 years. So the basic strategy is this. You basically take out a HELOC and you use that HELOC to pay down the principal of your mortgage. And I'll explain in a little bit more detail. So if you have a steady job, decent credit, and a little bit of equity in your house, what you can do is you can apply for a home equity line of credit with your local bank. And this author actually recommends talking to like 3 or 4 local banks. He kind of emphasizes local as opposed to some national bank, just because they'll have better terms, they'll understand the values a lot more, and you can probably get a better deal. So shop around for a HELOC, and once you get a HELOC of, let's say, $40,000, $30,000, $50,000, whatever it may be, the idea is that you're going to take that entire chunk of money in the HELOC and put it towards your principal. So if you put $50,000 towards your mortgage, that would obviously take out a huge amount from your payment. You still have to pay off the HELOC. So what he recommends doing with that is just putting your income, putting all of it towards your HELOC to pay that down. And obviously you still have expenses and things like that. So it's not like you're going to just pay off, let's say, $30,000 or $40,000 or $50,000 just in, you know, a couple months or anything like that. But if over the course of the year, you know, you direct deposit all your money into that HELOC, you take out for expenses and things like that, you can relatively pay off that HELOC usually within a couple years. And then what you do once you pay off the HELOC, you take out another HELOC, and this time you'll have much more equity in the property. So let's say you took out an original HELOC of $50,000. Once you pay that down and you've paid the $50K towards your mortgage principal, you take out another HELOC for, let's say, $100,000 because you'd have $50K more equity in the property. And you take that $100K and then you put it towards your principal. And you just keep repeating this process over and over until your mortgage is paid off. He's done this, you know, like I said, numerous times, and it's a pretty unique strategy. And really the whole idea behind it, and I'm not a finance person, so maybe a finance person could like poke holes in this argument. So the big idea behind this principle is that a HELOC has simple interest and a mortgage has amortized interest. And it's better to be paying simple interest than amortized interest. So you use the big chunk from the HELOC, put it towards the amortized interest, and it's going to turn out better for you and pay off your mortgage faster. So it's a pretty unique strategy, and obviously you can take out huge chunks out of your mortgage and possibly pay off your house in 5 years. So it's definitely a strategy I'm going to try out. Let me know what you think about this strategy, if you think it's worth it, if you think it doesn't work. Whatever your opinion is, definitely let me know. So comment below, and I'll see you in the next video. All right, bye.